number there.
Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Amazon. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today we're going to look at Amazon. And the title of today's show is Amazon is Partying Like It's 1999. May I ask, why would Brian make such a silly title for our webinar today? And it's because Amazon actually hasn't split since 1999. That was the last time it's actually announced a stock split. And that's the whole theme to the show today. We're going to be talking about that 20-for-1 stock split that Amazon is looking to do in June. And just like the momentum we were trying to ride the last time we talked about a stock split, which was in Google, not that long ago, back when Google was right around 2,600. And the markets in general, including all of the NASDAQ stocks, all of the FANG stocks, had been beaten up. Now we're seeing some strength in the marketplace. Amazon and Google have now, the fact that they're splitting, it seems like people have woken up to that news. And when you're splitting a stock, a lot of times it doesn't do anything to the fundamentals of the company. It's more like a party in that our stock price is so high, we're going to have to split it in order to allow people to buy 100 shares of our underlying stock and make it more feasible for that to happen. That's the main reason why companies will do stock splits. So, with that said, I'm going to start by just looking directly at my VIX watch list, and we'll talk a little bit about what's going on in the markets. The main point is that the markets have been strong. And last week we looked at the Fibonacci, and we mentioned a couple of levels that the Fibonacci is highlighting from the downturn. And right now we have the SPX that's up 0.75%. We see the NASDAQ is up almost 1%, and the small caps, the Russell, the IWM is the ETF that tracks the Russell, that's up 2% today. So as far as the markets are concerned, to see the Russell leading the way is a good sign for the market. So there's a lot of good news or good things to point out as far as the markets are concerned today. The VIX index down below 20. So that's kind of crazy to me. I guess I've talked a lot about there seems to be a lot of comfort in the way the market is going recently, even after the Fed has spoken, saying they're looking to do maybe 6 or 7 interest rate hikes before the end of the year, and the geopolitical concerns, obviously, but the VIX has remained pretty muted. And as a matter of fact, if I pull up the VIX index, which I'll do here in just a minute, we've broken below the 200-day moving average, which some people might be able to make a argument that we're actually in a rate of low in volatility, implied volatility, because we are below that 200-day moving average. You know, that's a long-term moving average, and we're trading below that right now. It's right now at 1890. But I'm going to stay on this smaller chart here and just highlight the numbers that we talked about on last week's show and look at where they're at now. So I haven't changed the Fibonacci here. It's in kind of an orange color. If I put my cursor over it, it kind of highlights it in red. And I'm going to look at that 61.8 number. So as far as the Fibonacci's are concerned, we've had a really solid retracement. We see a lot of green bars. This right here we did talk about, but this is considered a death cross when you have a 50-day moving average going through a 200-day moving average. And normally that would be considered a fairly bad death cross in that You have a 50-day, which is kind of slow moving in overall, and you have a 200-day average. When you have that 50-day, a slower moving average going through a 200-day moving average, that is called a death cross, and it usually means more than, for example, a 20-day moving average crossing over it. But the marketplace totally ignored it. It hung out right around the 200-day moving average for just a bit, and now broke up, went straight to 61.8 in about 4 or 5 trading sessions, and now it appears that it's blown through the 61.8 on the Fibonacci's. So with that mentioned, it puts the 100% retracement in play. That's where the next stopping point may be as far as the theory behind the Fibonacci numbers. So, like I said, a lot of good news. I'm really surprised to see the VIX below the 200-day moving average. So I'm going to add this to the chart. And I'm just going to show you now that strong move that we had to the downside, or to the upside in the SPX, a lot of green bars. Well, we're seeing a ton of red bars here in the VIX. And here's the 200-day moving average. And ever since the pandemic, there's always been a line in the sand in my mind as far as high volatility versus low volatility. And that was by the 20 level. That 20 level, it took forever a few years back when we had the big downturn in the markets because the pandemic was officially announced. In that instance, that 20 level was a long time before it broke it. And now we're below that. We're below the 200-day moving average. Just people seem content in the markets. They're not running to the S&P 500 index to buy put options to protect their portfolio. Hence, that's why the VIX index is often referred to as a fear gauge of the marketplace. This is showing more complacency in the marketplace than fear. All right, still a lot of news going on. And I have mentioned on Stock Play of the Day quite often that I'm just surprised to see the VIX down at these levels, and today is no different. So 3 or 4 weeks in a row, I expected the VIX to trade at a higher level, and it just flat out hasn't. So I'll take that as a grain of salt and say, well, I guess the VIX knew a little bit more than I did about the marketplace. Because the VIX was forecasting, well, I mean, I don't know about forecasting, if it's a leading indicator or a following indicator, but the VIX was basically looking at the marketplace and saying that a rally was possible. Okay, so today's stock, we got a lot to talk about. It's Amazon, and I'm just sticking with a theme. Nothing's ever meant to be a recommendation here on the Stock Play of the Day. But we went back and mentioned with Google that Google is doing a stock split. Stock made a big pop up on the news. It was around earnings. They had a solid earnings report, and then they announced the stock split. Stock went up. We had a lot of geopolitical things happening, a lot of things happening in the inflation world, and before you know it, all the FANG stocks got beaten up pretty good after Google's earnings. Took that as an opportunity to say, okay, well, the marketplace thought that the split was worthy of a move up in Google. Let's target that range and look at doing a long call spread where we're going to manage our risk. And in Google, we went out a little bit further in time, mainly because the split was further out. Amazon's going to be splitting in June, and we're going to have Google splitting in July. We actually used the August contracts. If you go back and look at that Stock Play of the Day where we talked about Google, or Alphabet, I should use it by its real name for that stock. But with Amazon, they're going to be splitting in June, and we're going to use that June contract because they're going to be splitting at the beginning of June. In Google, we did a risk-reward ratio where we put up about 30% to try to make 70% on that trade. That's the way we set up the risk-reward of the long call spread. In Amazon, it's a little bit shorter, a little bit different marketplace. So we're going to try to do more of a 50-50 situation. We're going to risk the same amount as we have upside on it. And this is what the Stock Play of the Day is all about, is taking what the marketplace is showing you and adjusting your play from the options playbook to match the pricing of that underlying. So I want to change it up a little bit because I don't always want to have the same theme on each and every show. So let's get into Amazon. Let me go and pull up a long call spread inside the options playbook. And this is the trade that we've discussed. And a big thing about very expensive underlyings is it makes options premiums very expensive. No regard to volatility, implied volatility also raises option premiums. The more volatile the underlying is, mainly because of news, earnings, stock split announcement, geopolitical concerns. So that's some concern as far as increasing the price of the option contracts. But now we're going to look at a long call spread, which means if you're buying a very expensive option contract, you're also going to be selling one. And on expensive underlyings, I almost always consider a long call spread over buying an option outright. So that's what we're going to look at today. And I'm going to run to the Ally Invest option chains, and we'll see where Google's at right now. Or I'm sorry, Amazon. Amazon right now is up 0.25%. It's up $7.53. It's had a very strong move to the upside. And actually, I think I'm going to highlight that. Let me jump back over to the charts and show that. And mainly because I wanted to highlight the fact, I took the time to put a Fibonacci on, so I might as well show it to you, that in Amazon, we have kind of the same move. Now, as far as the most recent downturn, there's been 100% retracement to that. And we kind of hung out at that 100% retracement line, and now we're breaking up. But I'm more interested in the highs of the marketplace, right around $4,440. We see that it's came back. This is where the high was in Amazon. It's been there a couple of times, going all the way back to July. And we see if we do that retracement, once again, we just broke through the 61.8 level, which is very similar to what we're seeing in the S&P 500 index. We have a big upturn here in the 20-day moving average, crossed over the 50-day moving average, and we just broke through that 200-day moving average. So in very similar, well, a little bit more beat up than the S&P 500 index did, which you would probably expect in a stock like Amazon, just to have a little bit more volatility, potentially to the downside. But the chart looks very similar, and there's, in general, just good news as far as looking at the chart and this underlying stock. Okay, so now let's get to the chains. Okay, so before I go there, though, please, that chat box is open up. We like to make this as interactive as possible. Tell your friends, tell your family, let them know that we're talking about the Amazon stock split today, and please share our video with whomever you would choose to. But with that mentioned, if you have any questions, in particular just about stock splits, because stock splits get a little messy as far as the options marketplace is concerned, and that's mainly because there's a contract and there's a set term and conditions in that contract that's going to have to get adjusted when the underlying price changes. All right, so 3,386. I'm going to pay a little bit of attention to the time premium that I'm buying in Amazon. Like I mentioned, early June is when the stock split is supposed to occur. It's going to be, it looks like on June 6th, which is a Monday, it's supposed to be split adjusted. So on Monday morning, for every share of Amazon that you had in your account, you should now have 20 shares. And you will see that reflected in your account, hopefully, on June 6th after all the back office work gets done because of that split. So we're going to go out beyond that. We're going to go to the June 17th expiration. That's 80 days away. And I've mentioned this a lot with long call spreads, is that you would rather be correct on your forecast closer to that expiration date than sooner. So normally, if we're doing something because of a charting pattern or a purely speculative play, we're only going to go out a couple weeks in time. But we're specifically doing this because we're anticipating, we're hoping, there's no way of knowing, that the momentum that's been generated by the stock split in Google and Amazon, and now Tesla's actually mentioned a stock split, that might drive the marketplace higher. So we want to go beyond that split date. And also we want to pay attention to the strike prices that we are choosing. And part of that reason why is that we really don't want to end up with a fractional strike price. Now in Amazon and Google, it's not that important because of the liquidity of the marketplace. They're very liquid option contracts, and that kind of helps. But after the split, you will have a different strike price on your option contract. And if you're using a nice round number, like I'm going to highlight here, 3360, you're going to divide that by 20, and you're going to end up with a nice round numbered strike, which will be more attractive to new investors that are coming in and wanting to trade option contracts. So that's a little trick of the trade that you always want to be aware of. And if you go to theocc.com, it will actually do the conversions for you. There is a PDF that is put out that explains what's going to happen to each and every strike price in Amazon after the 20-for-1 stock split. Okay, so we're going to go a little deep into money. We're going to look over at the put and see how much approximate time value that we're buying. So markets are a little wide because it's an expensive underlying. We're talking 177 by 180. Let's call it $181 at the midpoint, rounding a little bit. And that means that's the approximate time value that we're paying if we bought this option outright. And I'm going to highlight the fact that it's a $216 option. So you're talking about a $21,000 to just buy this, $21,615 to be more accurate, plus commission just to buy that option outright if you paid that asking price for it. Now, don't want to pay that much for that option contract, not to mention there is a lot of juice in that option contract. So we're going to spread it off, and that's the moral to the story today. And we're going to go out and target that high area. So let's go back and let me finish the trade, and then I'll run back and just look at the chart. So we're going to target that area, and we're going to sell the 3480 strike. And I picked this strike more so because I'm looking at the amount of time premium that I am selling on this trade. So I'm buying about $181 worth of time premium, and I'm selling, obviously this is an out of the money option, we'll call it $155 worth of time premium. That means I have exposure of about $30. If I want less exposure to time premium and time decay and implied volatility fluctuations, everything that makes an option, I could go down and say, all right, I want to target the 3430 area of on the option contract and sell something a little closer to the midpoint, and then have more of the fact that I'm just relying on the movement of Amazon going into the split and after the split. So that's a little bit more conservative. I'm going to go a little bit higher, pay a little bit of time premium, have some of that exposure. Okay, so moral to the story, once again, in this little story, is that pay attention to time premium when you're buying long spreads, in particular on expensive underlyings. Always want to be aware of how much exposure you have to that, because that's what makes option trading so much different than trading stocks. And if we do that here, we're going to be the difference between the strikes is the maximum that we can make on this trade. So right now we're looking at 120 points, and we're looking to pay $60. Okay. So we're risking $60, or in this instance, it would be if we could fill at the midpoint, $5,855. And we're looking to make double, well, basically what we paid for it. So Our risk is 50-50 because the maximum it could trade for is the difference between the strikes or 120 points. And that was my goal of targeting going a little bit further out of the money, giving myself a little bit of risk to that time premium exposure and time decay. But I'm getting a situation where I'm going to be investing $60 with the potential of making $60. I'm managing my risk by doing the long call spread, and I'm giving myself a fear of missing out, a toe in the water without all the exposure to buying a call option outright. So let's look at the trade. This will be the official paper trade. And I'm going to put this in the right rail. And then we'll go down and look at the profit and loss graph. So this is where Amazon is at. I'm going to hit the midpoint of 58. We'll call it 58.60. That's nice. It bounced right there. I'd want to trade somewhere near the midpoint, especially to get into this trade if I can. And it's not always a guarantee that we can do that. So the total cost of this trade would be $5,860 plus commissions to put it on for every 1-by-1 spread that we did. And our total upside would be, we'll call it $62. That's what we'll call it. We'll round off a little bit. Or $6,200 less commissions would be our total upside on that trade. Okay, so that's the official paper trade. Let's talk a little bit about some of our concerns by going so much further out in time. Okay, and I'll zoom in a little bit on the profit and loss graph. Here's our paper trade for this week that we're looking at. Okay, so I got the paper trade in. Down below, we're buying the 33.60, selling the 34.80, going out to the June expiration, about 80 days away. And when we first start, because of the sheer cost of the option contracts, if we get to move to the upside, we see that the colored line here, which is representing as of today, just doesn't really give you a lot of upside and not a lot of downside. But as expiration approaches and some of that premium comes out, we'll go all the way down to 10 days to expiration. Now you're going to see, I got to go 10 days. There we go. Now you will see that colored line is morphing towards the dotted line, which appears at expiration. Let's go down to 1 day. Now it's starting to act more and more, and you see the theme here that if we're correct on our forecast, we would rather be closer to the expiration date than have it happen right away. Now, if it does blow through that level on the upside, well, the more and deeper it gets in the money, the more and more it will start acting like the dotted line or like the expiration graph. But also going to highlight on the downside, if you're incorrect on your forecast, it also does that. Now, that's a bad thing if you're wrong, and it's a good thing if you're correct. And one reason why I don't mind going out further in time is if I am incorrect and the market does make a strong, let's say 100 or 150 point swing to the downside, it allows you to do something because there is time premium. So there's good news about that premium sticking around if you are incorrect on your forecast, right? Because then I can adjust it. I can roll it into a butterfly. I could do some different things with the trade. On the upside, though, you just don't get your gains quickly until you get some of the time decay in that option contract that you sold. You need that to wither away a little bit before you can get a max gain in any long call spread that you're doing. So interesting times. Tesla, Google, Amazon, all announcing stock splits. These are the type of trades that I would consider are long call spreads, or even you could even sell some put spreads if you wanted to be bullish on it, or you could go the opposite side and do a long put spread to be bearish on the underlying. The moral to the story, which is now my third time saying that, is that if you're looking at these expensive underlyings, you want to consider doing spreads as opposed to buying options outright. All right, so let's get to the chat box, and I'm going to check this out, see if we have any questions in here. All right, so William says, hi, everyone. Hello, William. Another William, so we got William squared out there today. How do I add the Fibonacci to my charts on Ally Invest? Use it regularly in FX trading. Okay, so I guess I can run to it. It's fairly simple, but we're kind of looking at questions based around the option strategy today. But it's just this little drawing tool. You just click on this little drawing tool right here. And once you click on that little marker or chalk or whatever you want to say, and then you just select the strategy. And then you can do the Fibonacci. Quite simple. And then to remove it, all you do is right click it and then it goes away and you can see the chart a little better. Any other questions that we have? Any questions around the strategies? And if not, that's all right. We're getting to the end of the half hour here. Every Friday, we do the stock play of the day overtime. And the stocks are moving. So we should have an opportunity to chat a little bit about this. But with the Amazon split and the Google split and the fact that we're going so far out in time, we'll come back this Friday. We'll talk a little bit about it, but there probably won't be much adjustment to the trade because of the things that I mentioned. The fact that if the market goes down, it doesn't hurt us as much. If the market goes up, it doesn't help us as much. So I would be looking to adjust a little bit closer to the actual news event. And if the market does what we'd like it to, well, then there's really no adjustment whatsoever. So we will look at this Amazon trade on this Friday, but we're going to come back and we're going to also talk about on an overtime issue. We'll talk about both Google and Amazon as we get closer to the split date. All right. So one last check of the chat box. It looks like a lot of thank yous out there, and I appreciate that, Clinton and everyone, but that's going to be it for this edition of the Stock Play of the Day. Please click subscribe, ring that bell. See you this Friday for Stock Play of the Day overtime. Thanks for coming, everyone.